If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly.
All right, that was Fed Chair Jay Powell yesterday after the central bank cut rates by 25 basis points and signaled that the pace of cuts could slow next year. Joining us right now is former Fed Vice Chairman Roger Ferguson. He's the former president and CEO of TIAA. He now serves as vice chairman of the Business Council, and he's a CNBC contributor. And, Roger, we've been waiting for you to be our Fed explainer on all of this. It didn't seem to me like what Jay Powell said was anything that was hugely shocking. It was kind of welcome to see a very hawkish version of this because so many people have said they weren't even sure they should cut rates at all. But it did come as a huge shock to the markets. What do you think of the market's reaction? What do you think of what Jay Powell said, and how should we interpret it?
Well, let me start at the second question, which is I think what he said was absolutely right. You know, he recognized that on a 12-month basis, inflation has been moving sideways for a period of time, and it was therefore time to really change the narrative. So I think what he did was right. Why did it shock the market? You know, good question. I think the market has gotten itself used to the Fed being very much on a track without actually looking at the underlying data. I'm not sure why they were ignoring the fact that the market was ignoring the fact that inflation was not moving down as quickly as people had hoped. And so, I think this is, the miracle season, the miracle of Hanukkah, the miracle of Christmas. The Fed proved that it was not going to, continue this miraculous approach. And I think they did exactly the right thing. And the market, adjusted appropriately.
Okay, so the idea that the market was not listening to what Fed officials had been saying, had been hinting, are they too reliant on the dot plot, thinking, OK, we're still going to get all these cuts, maybe looking at it? Because I even look at the dot plots now that suggest that there are 2 more cuts coming next year. And I think those are questionable. Maybe we'll see. But I wouldn't be marking that in and betting money on that at this point.
I'm completely with you. I mean, they have attempted to say many times that the dot plots are not a forecast. If the economy unfolds as expected, then perhaps the dot plots will come to be true. And so I think it's very wise to look at them through that lens. And never forget that, while there's the so-called dual mandate, inflation is the most important thing that the Fed has to look at. And they have to be grounded in reality. They were confident that it was moving down. And there are ways to look at it to suggest that it was moving down. But that has clearly stalled. And so I think the market was ignoring the data that were coming in and putting too much weight on, like a type of forward guidance that was already, out of date. And so I'm very much with you. I'm not sure that they're going to get 2 cuts off next year either. We'll see how things unfold.
Roger, we never know if there's a mistake. And it's a really, it's very difficult needle to thread to do everything exactly right all the time. But in the past, there have been mistakes. I mean, if they had to take back the 100 basis points that we got, and if the 100 basis points cut is why we stalled in terms of our progress on inflation, because it was too soon. I mean, it's possible, isn't it, that we could get no cuts next year and actually be back to hiking if inflation really, if we're underestimating how resilient inflation is, and God forbid, we could still have we could be messing up both sides of the mandate. We could also have a slowing labor market while that's happening.
I think Chairman Powell acknowledged in the clip that you played at the very beginning that's a possibility to go either way. When asked, about a rate hike next year, I thought he was pretty tentative before saying, that's not the plan. I think there is no, at this stage, there is no pre-cooked playbook that will determine what happens next year. It's going to be incoming data. We have inflation that seems that it's stalled a bit. Labor market that is, imbalanced, but I would not say it's softening dramatically. And frankly, we have an economy that appears to be growing at or slightly above trend. And then a brand new set of policy initiatives. So I think, to your point, it's a formula for either thing occurring depending how the data play out. And as Becky just said, I wouldn't put too much weight on the dot plots at this stage
But
because it's
you think we're at
contingent
neutral,
upon how the
Roger?
economy plays out.
Right now, you think we really are at neutral? That means that what we thought was restrictive wasn't as restrictive as we thought.
Well, as I said to you a few times on the show, the economy has been growing roughly at trend, maybe slightly above, and so that does imply that we are probably closer to neutral maybe than the Fed itself recognized. Right. Then we add to that, in some places, very loose financial conditions. Think about equity markets. That's not the only way to measure it, but certainly there's a still ongoing wealth effect. So I've always been in the camp that we don't know where neutral is, and maybe it's higher than we thought, and perhaps that's exactly where we are today.
So, Roger, we've got to go, but it sounds to me like you think the market's reaction was appropriate if they were listening to Chairman Powell's message and interpreting it as, well, there may not be more cuts, there's going to be a much slower pace of cuts, and as a result, selling off when it comes to equities and seeing the 10-year yield pick up a bit. Did that surprise you to see the 10-year go above 4.5%?
No, it's all part of the same story, which is, we're not as confident that inflation is coming down. It's moving sideways. Let's price it in, and that means price in fewer Fed cuts and possibly no Fed cuts. So I think the market did the right thing.